Good morning and welcome to Capital Sound. We're waking up to a market that looks calm on the surface, even as oil is back in triple digits and blockade headlines keep building. I'm Mandy Prince, and with me today is Milan Patel.
Morning, Mandy. Glad to be here.
Quick snapshot before we dive in. Major indexes are modestly lower early on, volatility looks muted, and energy is firmer with oil above $100. Yields are a touch higher, and leadership feels narrow. That's the surface. The real question is, why is the market shrugging off what sounds like a real supply shock? Milan, here's the provocative question. If this is a real blockade and oil is in triple digits, why is the market acting like it's a rounding error?
My core view is that the market is mispricing the inflation shock, and some of the calm is artificial. The oil move matters because it tightens financial conditions and forces a tougher math on equity valuations. And the calm on the tape feels like a positioning squeeze, not a fundamental conclusion.
That's a strong claim. Walk me through the tougher math.
Start with what the business is paying for energy. If input costs rise meaningfully and stick, margins compress unless pricing power is exceptional. Then there's the discount rate. When inflation expectations firm up, the rate you use to value future cash flows rises, and the multiple shrinks, so you can have growth hold and still see valuations reset. That's the basic transmission.
Hold on, let me make sure our listeners are with us. You're saying higher energy costs hit profits directly, and higher inflation expectations push interest rates up, which makes stocks feel more expensive even if the business is fine.
Exactly. It's not about panic, it's about arithmetic.
The other side says this isn't about arithmetic, it's about the tape, meaning who has to buy or sell. Do you buy that?
I do, up to a point. The tape can run ahead of fundamentals for a while, especially if positioning is one-sided. But that doesn't change the downside in the long run. You can't outrun costs.
You've got two lenses here, macro math and tape dynamics. Let's sharpen them. Give me the 1970s style energy math in today's market.
Here it is. Higher energy prices act like a tax. It bleeds into transport, manufacturing, and household spending. Then it feeds inflation prints, which pushes policymakers to lean hawkish. That combination compresses multiples. This is 1970s style energy math in a 2024 risk-on costume.
That's the line. Now take the other lens, the tape.
The tape is high on positioning fumes while the fundamentals throw punches. Risk appetite can mask the problem for a time, especially when a lot of money is forced to stay invested. But it's fragile. If the shock persists, that fragile bid can snap.
I hear you, but let me push back. Markets have powered through ugly headlines before. Why is this different?
Because this is a cost shock, not just a sentiment shock. In 2022, we saw how a rate shock quickly repriced equity multiples. If oil stays elevated and policymakers react, it becomes a structural issue for earnings quality and valuation. That's not a headline, it's a math change.
That 2022 reference matters. So you're saying this could rhyme with that?
It could, not in magnitude necessarily, but in the mechanism. The mechanism is what I focus on.
Let's move to tariffs. Is this real policy risk or just negotiating theater?
It's a policy overhang until it isn't. I don't speculate on political outcomes, but I do watch the signals that would make it concrete. Formal proposals, timelines, and corporate guidance that starts to reflect it. If it becomes real, it magnifies the oil shock by raising import costs and squeezing margins.
Translate policy overhang for our listeners.
It means there's a headline risk that can alter the economics of a business, but it hasn't become a rule yet.
Okay, so if tariffs move from noise to policy, what does that do to the market?
It adds a second inflation impulse. Energy is one channel, trade is another. Together they push inflation expectations higher and create a higher required return. Even if growth holds, you can get a valuation reset.
You're describing break-evens and term premia, which is a mouthful.
In plain English, it means investors start demanding a higher return to own long-duration assets because they fear inflation will stay hot. That higher return requirement pushes down valuations.
You're not a macro strategist, but you're talking about macro mechanics. How do you keep this in your investing frame?
I pull it back to downside protection. I ask, what could actually hurt the business over a multi-year period? Persistent higher energy costs and trade barriers can do that. I don't need to predict the next month. I just need to avoid owning a fragile business at a fragile price.
That's your gravity center. Let's do the clash more explicitly. On the one hand, inflation math, on the other, tape and positioning. Which one drives the next leg?
Short run, tape can dominate. Long run, economics wins. My concern is that markets are treating a persistent cost shock as if it's a short-lived sentiment shock.
You said positioning fumes. Some listeners will wonder, is that just a fancy way to say FOMO?
It's similar. It means flows are pushing prices higher because people are already leaning bullish, not necessarily because the underlying earnings power improved.
Let me challenge you. If the market is a pricing machine, shouldn't it already be reflecting these risks?
It should, but it doesn't always do it on time. I've learned the hard way that markets can ignore a risk until it becomes unavoidable. I got burned in 2020, assuming bad news would instantly show up in prices. It didn't until it did.
That honesty is useful for listeners. So, in your framework, what's the first place you look for risk right now?
Exposure to energy costs and pricing power. If a business can't pass through costs, the downside increases. Then I look at balance sheets. Higher rates make leverage more dangerous.
That's very Milan, but the tape isn't your compass. How do you reconcile the calm with your caution?
I don't need to reconcile it. I can acknowledge the calm while saying it doesn't change the downside. It's worth watching, not acting on.
Let's go to a slightly different angle. Singapore's inflation prints have been watched as a global signal. What does that tell you here?
It's a bellwether for imported inflation and the policy response in Asia. If inflation stays sticky there, it suggests global pricing pressures aren't fading. That feeds into global discount rates, which matters for equity multiples everywhere.
Translate discount rates for someone who doesn't live in a spreadsheet.
It's the rate investors use to value future profits. Higher rates make future profits worth less today.
If Singapore shows sticky inflation, what do you expect from policy?
More hawkish signals, or at least a reluctance to ease. That divergence, policy tightening signals while risk appetite expands, is a classic mismatch.
And you see that mismatch now?
I do. The fundamentals suggest caution, while equities are acting like the path is clear.
I can almost hear people saying he's too cautious. Where do you see the market being rational?
If the blockade fades quickly and energy prices settle, the market can justify a shrug. In that case, the shock is short-lived, and the fundamentals may not deteriorate.
So you can concede the optimistic path.
I can. I'm not locked into a bearish view. I'm locked into a downside-first framework. If the downside goes away, I lighten up on the caution.
Flip it. If oil stays above $100 and tariffs turn real, what happens?
Then the next downdraft won't find the same marginal buyer. Positioning would already be stretched, and the market would have to confront higher costs and higher rates at the same time.
That line is hard to ignore, but you're also saying there's a plausible path where this just fizzles.
That's right. Markets have powered through similar headlines before. I'm not blind to that history.
This is a contested episode. I want two paths cleanly laid out. Scenario A, what happens if the blockade fades and tariffs stay a threat but don't become policy?
Scenario A, the favorable one. If the blockade eases and tariffs remain a headline risk, then energy prices cool and inflation pressure fades. Equities can hold up because the cost shock becomes temporary. The signal to watch is whether energy costs start rolling over and whether companies stop mentioning input pressure in filings.
Scenario B, if oil stays above $100 and tariffs become a real policy path.
Scenario B, the risk path. If oil stays elevated and tariffs move toward implementation, then inflation expectations firm and policy remains hawkish. Multiples compress and cyclical margins get squeezed. The early warning sign is companies calling out persistent cost pressure and any official move that signals tariffs are no longer just talk.
Which scenario do you think is more likely?
I'd say the risk path has a higher probability than the market is pricing, but I'm not claiming it's the base case. I just think the downside is underweighted.
That's precise. Let's make this practical without making it advice. How should listeners think in this kind of environment?
This is a time when patience beats speed. Reduce the number of decisions you make and focus on businesses with resilience, pricing power, low leverage, and predictable demand. That's the kind of setup where the downside is protected.
That's framework, not a trade. Good. I want to test your framework against the tape one more time. If the rally keeps going, Do you feel pressure to chase?
No, I've learned that chasing can be more dangerous than missing. If I can't protect the downside, I'd rather wait.
That's the patient cloner in a nutshell.
I try to learn from the best investors. They don't win by reacting quickly, they win by reacting correctly.
You haven't named names, but I know who you mean.
I keep it simple.
You mentioned filings earlier. What are you looking for in them right now?
Concrete language on input costs, pricing power, and any shift in demand. Filings are where you see if management is preparing for a tougher environment. It's less noisy than headlines.
That's a solid filter. Let me ask a human question. When you see the market calm and your framework says not so fast, how do you stay grounded?
I remind myself that I don't need to be right today. I need to avoid being wrong in a permanent way. Calm markets can be seductive. The discipline is to ask, what could actually hurt this business, and act accordingly.
That's a useful check. Before we wrap, I want your take on the phrase, "this is a trap." Do you believe that?
I'd say it's a risk of a trap, not a certainty. The rally could hold if the shock fades, but if it doesn't, the air pocket can be real.
You're not sensational, you're cautious.
That's the idea.
Let's do one quick historical echo. We saw something similar in the 2022 rate shock. Markets didn't react immediately, then repriced. Does that inform you?
It does. It reminds me that the market can delay the response, but when it moves, it can move fast. I don't try to time it. I try to be prepared for it.
That's clear. Time for the one takeaway moment. If listeners remember just one thing from tonight, what should it be?
If the cost shock lasts, the valuation math changes and patience is the edge.
Simple and memorable. Now the watch list. 3 things to watch. 1, how long oil stays above $100. 2, whether tariffs move from headline risk to a real policy path. And 3, global inflation print with Singapore as a bellwether. And a brief note, any Fed leadership chatter is a policy overhang, not a forecast, just something to keep in mind.
I agree with that list. And if any 2 of those 3 shift together, the market's calm could break.
Milan, give us a final one-liner for the road.
Slow thinking beats fast reacting when the downside is uncertain.
Thanks for listening to Capital Sound. Have a great trading day, and we'll be back this evening with a full recap of how the day played out. Have a steady morning, and goodbye.